If you or a loved one need care and you've established that you will need to pay some or all of the costs yourself, this makes you a self-funder. There are 9 main ways for you to pay for your care, which I summarize in my video, Paying for Care as a Self-Funder. In this video, I'm going to explain the advantages and disadvantages of the 8th of those 9 options. Buying an immediate needs annuity, or another type of long-term care insurance product. Long-term care insurance products broadly fall into 2 types. Risk-based insurance products, also known as pre-funded products, and immediate needs products, usually referred to as immediate needs annuities, sometimes called immediate care needs annuities or immediate needs care fees payment plans. Let me start by considering the pre-funded products. So recently I've seen several protection products launched that include some form of long-term care protection. So this is where the benefit levels are restricted and may or may not be sufficient to pay for care costs over time. There are 2 main types of pre-funded care products. The first, which is a typical insurance policy that requires the regular payment of premiums and provides protection in case care is required, based on your ability to complete a number of activities of daily living. The other type of pre-funded care plan is a combination of a lump sum investment bond with a protection policy. And the idea behind this arrangement is for the long-term care investment bond to produce sufficient income to pay the premiums for a care protection plan. The main benefit to this type of product is that with careful planning, some of your assets would still be available to be passed on to your beneficiaries on death. However, due to falling investment markets, the returns may be unlikely to be able to maintain the premiums required on the policy. So these products are rarely available anymore. Paying for care using pre-funded products may be suitable where you wish to provide some degree of protection against the cost of care fees that we might incur at some future point. So on the flip side, this may not be suitable for you if you have an immediate need to fund your care fees, or you wish to insure against the full costs of future care. Advantages include the fact that these products can be funded by a regular premium, i.e. they don't require a lump sum, and the premiums can be cancelled at any time, subject of course to the policy being cancelled. On the downside, this type of protection would not provide a repayment of premiums if you never made a claim, nor would it generate a cash-in value at any time. Therefore, it could prove totally unnecessary in hindsight if you don't need care fees or you don't have care fees. Or, of course, where you might qualify for NHS continuing healthcare, which of course is free. Risk-based insurance products may contain an option to pay out all or part of the sum assured in the event of you being unable to perform several activities of daily living. If you do have one of these policies, any eligible payments could either meet or make a substantial contribution towards the cost of your care. So moving on to the second kind of long-term care insurance product, an immediate needs annuity. I see much more of this. This is simply an insurance policy that works in the same way that an annuity would in retirement. So in return for a set premium, i.e. a capital payment to an insurance company, the policy undertakes to pay a regular income towards your care costs for the rest of your life. The level of the premium depends on things such as your age, your health, and the expected level of current and future care fees. Paying for a care using an immediate needs annuity may be suitable if your health is impaired, as the cost is likely to be lower. It's most often used when you're already in a care home or about to move into one, or receiving care at home. And if you want the peace of mind of knowing that you have a regular income for life that can be used towards care costs, this could be for you. Equally, if you want to cap the cost of your care and take no investment risk, of course safeguarding your remaining capital and any other assets. It may not be suitable, however, if you're in great health and don't need to pay for care immediately, or if you think you may only need care for a short time. Critically, you won't need to take out an immediate needs annuity if there's a good chance that you would be entitled to NHS continuing healthcare funding, which of course is free. There are quite a number of advantages of immediate needs annuities when this option proves to be the most suitable. It's important to note that this is currently the only product that guarantees payment of care fees at a selected level for life, which of course brings a huge sense of security and reassurance. The income is guaranteed to continue until the death of the person needing care. And this of course means that your family can feel confident that they are unlikely to have to make up any shortfall in costs unless increases in fees outstrip income payments at some future point. This kind of annuity is very tax efficient because the benefit is paid directly to a registered care provider without deduction of tax. You can also be, registered care provider, a care home, or a care agency that is registered with the Care Quality Commission, or its Welsh, Scottish, or Northern Irish equivalent. This makes it completely tax-free and it will not affect any allowances being received. The annuity can also help to pay for care at home and retain the same tax efficiency if this is supplied by a UK registered care provider. The benefits can be paid directly to the policyholder if required. For instance, if you were receiving care at home provided by non-registered carers, but the benefit or the income payable would be taxed in the same way as a purchased life annuity. An inflation element can be included, which can obviously help offset future increases in care fees. And for an additional single premium, part of the capital paid into the policy can be protected in case you die early. Be aware that any lump sum death benefit will be paid into your estate and may be subject to inheritance tax. The policy can be transferred from one care provider to another if required, and if you no longer need care or your fees reduce, part of all of the annuity can be converted to pay personal income, subject of course to your marginal rate of tax. What's more, the annuity is protected by the Financial Services Compensation Scheme if the policy provider is unable to meet its payment to you. When it comes to inheritance tax benefits, the payment for the annuity will remove an equivalent value from your estate, the estate making the payment. And as such, if your estate is likely to be subject to inheritance tax at some future point, assuming a continuation of the current inheritance tax rules, the net cost, i.e. the purchase price of the annuity, you could view, because it's reducing your estate, it'll reduce your inheritance tax liability. Therefore, it may make it even better value for money. Finally, when the premium for immediate needs annuity comes from a larger investment portfolio or other liquid assets, you could then consider a more aggressive investment approach to be applied to the balance, because you now know your care fees are being met and guaranteed. That's quite a long list of advantages, but as always, there are some disadvantages to consider too. Buying an immediate needs annuity requires a significant sum of money, and there may be no cash-in value. And once it's been taken out, there's no going back. The plan can't be cancelled after the first 30-day cooling off period. So to get some of the money back, for example, you stop needing care. In such circumstances, any ongoing payments will be subject to income tax at your marginal rate. So you need to weigh up the peace of mind of having a regular secure income to pay for care versus the loss of the lump sum you've invested should you die sooner than expected or planned for. There is of course a chance that the annuity may not ultimately keep pace with the increasing care fees. Of course, that depends on the basis upon which you set it up at outset. In such circumstances where there is a shortfall between the cost of care and the income payable from the annuity, you're going to have to make this up from other resources. Income payments from the plan may affect entitlement to some means-tested state benefits. So that concludes my overview of long-term care insurance products. It is, of course, best to consult an independent financial advisor who's accredited by SOLA as a later life accredited advisor, someone like myself, who can assess all possible ways for you to fund any care you may need in later life. One of those types of advisors should build a lifetime cash flow. It's what I would do, that takes accounts of all your savings, investments, and other assets, and considers your income and expected expenditure for the rest of your life. They should help evaluate each option. And if you decide that an immediate needs annuity is right for you, the advisor will be able to source quotes and put the plan in place. To find out more about the other 8 main ways to pay for care, check out my show notes for links to other videos in this series. Thank you so much for checking out my YouTube channel. I'm Justin King, and my aim is to help people live successful lives. And that often involves understanding your money. If you've enjoyed this video, please press the like button to help more people like you find my channel, and check out the show notes, as I've said, for some useful links on the things I've discussed in this video. For now, I'm Justin King, helping you live your best life.